Hello everyone and welcome to Confident Compounding with Corey Kramer. This video is going to be a little different than my normal videos, which usually include me analyzing an individual stock. Occasionally I'll have some more commentary than that, but that's my main format here. But what I've run into lately and what's kind of slowed me down on getting to some of these requests that I have back on the chalkboard is I find myself more and more including or needing to include or feeling like it should be included some sort of technical support and positive momentum in a stock before buying it. And I've been doing this for a while now, which is kind of how it works. Like I do things on an individual basis almost by instinct because I can see the danger on this stock or the next stock or whatever. But I don't really have... It takes me a while before I realize maybe this should be a little bit more formalized guideline. So I'm not kind of it's not really a contradiction, but it's not part of my normal kind of the way that I normally do things when it comes to buying stocks often. So I want to make a video explaining why this kind of shift, why I've been making this shift or including it more, and why it'll probably be more of the default approach rather than kind of the exception where I notice something that makes me kind of a little more cautious with a stock, where I'm not just going to base it on valuation or whatever. I'm also going to look for some signs that there's some sort of a bottom. And so this video is going to explain why. So this is going to mostly be for my longer time viewers, or people that have kind of just joined up and they're trying to figure out what the heck I'm doing with some of these analysis. So typically I'm going to get into the reasons here, but I'll set this up by saying, like, typically anybody is doing any kind of like valuation style of strategy. Now I have multiple strategies. Most of them have a valuation component, except for maybe my REIT strategy. There's some sort of valuation component going on there. My cyclical strategy, that's less obvious. It kind of takes place where I filter out the poor quality businesses, and that's kind of where and I assume that the valuation will improve over time, even though I'm not doing a valuation calculation, but more for any type of earnings-based analysis, the time until payback analysis you see me do, the full cycle analysis where I use a 10-year CAGR earnings estimate. And then if you're part of one of my main services over on Patreon, the full service there, or the Cyclical Investors Club over on Seeking Alpha, I have a fast growth strategy that isn't like fully public, but I have a valuation component to that as well. And I don't usually get into the specifics of a couple of those strategies on the public YouTube channel, but I try to apply some sort of useful, hopefully, information when people ask me about faster growth stock. Usually I'll use the time until payback and adjust that a little bit, which is earnings based. So it's a little, now for growth companies, I've always at least the past 2 or 3 years, past couple years, I've had a momentum factor that I want to be positive before buying those, because they can fall a lot, and almost for the same reasons some of the reasons I'm going to talk about here. If you can get it's over time, I think you lose less money by letting a bottom get established, not trying to pick the bottom in an earlier, smaller stage growth business, and potentially while you're waiting, have news come out that makes the business less attractive, like poor revenue or whatever, compared to what they had in the past. You tend to do better by being patient and waiting for that bottom to form, rather than trying to pick a certain spot on the way down before whatever's got the market jittery kind of works itself out. So if you use any kind of technical bottom, I'm not a technician necessarily, but if you wait for positive momentum to be established in the stock price, then you're not going to, almost by definition, be buying it at the bottom, right? So you want to do that during situations where the bottom could be deeper than you expect. So you're not paying too much or buying too early during a downturn. So far, 90% of the stocks that I've decided to be cautious on and wait and have turned out to be very good decisions. And if you can eliminate two or three of those a year, actually each one counts, right? If you avoid a 50, 60, 70% loss, even in an unconcentrated portfolio like I have, if you can avoid a few of those a year that you might otherwise buy, it makes a big difference over time. So these edge cases are really important. I actually think that's where the alpha is. I've been doing this long enough now where my basic thought is if you use a sound strategy, almost any type of strategy, if it's relatively sound and you understand it, that will usually get you market performance. That will usually be enough so you won't underperform the market. The outperformance comes on the edge cases, on the 3 stocks a year that fall 80% that you avoided at the last minute, and the 1 or 2 or 3 that you were cautious about but you went ahead and bought that turned out to be good. That's where the alpha comes from, in my opinion, on an unconcentrated portfolio from like a bigger method. Now you can have a concentrated portfolio and get lucky, but you can also get unlucky. So this is more of a systematic-ish type of way that I'm trying to explain this. Okay, so I wrote down here like 6 things that have kind of made me come to this conclusion. So, what I'll say is, just for simplicity's sake, when I say positive momentum, let's just say that's the stock rises over the 200-day moving average and stays there, like a week, right? Not just because sometimes they'll bump up against that or go slightly above and then they'll sell off pretty quickly. Once it gets above the 200-day moving average and it kind of stays there, at least for a little bit, usually that I would consider to be generally positive momentum, right? Especially if it's over it for like a month. But the price might be higher at that point. Well, almost by definition, it will be. So you're going to take away some of your potential profits by paying a little bit more. And you might miss out on one sometimes by doing that. But we'll just use that as the definition of what I'm talking about. But you could even maybe use AI to say, as of this day, does this stock, has it formed a technical bottom or something like that? Or does it have positive momentum? And see what it kind of gives back. Because there'll be enough people posting on the internet that the AI should be able to go out and give you a pretty good consensus on what real technicians think or what the real technicals kind of look like on a consensus basis. But that 200-day moving average, I like to use monthly. I have certain ones that I think work a little bit better, but and then I use Seeking Alpha's momentum score too. But for just anybody can use the 200-day moving average if they have a brokerage account. So you don't need anything special for that. So we'll just use that as the definition here. Okay, so I first started being cautious about things when I saw that the post-US COVID stimulus bust was going to happen, okay? And that I noticed in January 2022, this is just S&P 500. It's not actually the best example, but it's the only aggregate ETF I think that maybe is on Seeking Alpha. So I could use a bunch of individual stocks. Now that happened to be one of the peaks here of the S&P 500. And so I started getting cautious right at the January of 2022. I sold off a lot of my cyclical positions because basically what happened is people went out, they spent a bunch of stimulus money, and a lot of that stimulus money was expiring, not getting renewed, things like that. So there wasn't going to be as much ongoing stimulus, and the market had kind of priced in like there was, right? It took that's 2022. It took 2 years for the market, for the S&P 500 to recover, basically those 2022 highs. So that's the first thing. We have this post-pandemic bust, and you can see it if you look at even Meta, which I own. If you look at Meta stock, you really see it. Peaked here, and this is earnings. Earnings fell 38% in 2022. Perfect example. And then eventually we got the AI boom that kind of started getting people back in. Also, if you look at Google, you can see it as well. So again, big boom in 2021 when all that stimulus was out there, and then a bust. Earnings fell almost 20%, and they cut a ton of people. They cut a ton of work. They stopped projects. They cut a lot of costs to limit that decline to about 20% earnings. So you can almost see it better with Google and Meta. So that's the first time I was like, okay, we probably need to be prepared for like a recession, a down cycle, blah, blah, blah. Now, right after that, in late February, or I think it was, and maybe it was even earlier in February, Russia invaded Ukraine. So this is the next big danger that's kind of layered on all these. It's caused me over time to kind of become more cautious about buying things on the way down. And that's changed. It's sort of brought to the forefront a change in the world order, essentially. If you listen to Ray Dalio, go Google him, watch him. He just did a great interview on Diary of a CEO. He has a good interview with Tucker Carlson. He has, you can kind of pick whatever interview style you like and go watch Ray, and he'll talk to you about all the dangers and stuff that's going on with the shift in the world order. So that's important because the international neoliberal trade regime that we've had for the past 60, maybe it's even more than 60 years now. I mean, it could be like 75 years or so. That whole mentality is disintegrated pretty much. Let's just say it's been altered massively. This goes with all the populism and everything else that's going on too. But it's not just economic, it's also military. It's also definitely like psyops and stuff. If you look at what's happening on the social media platforms with bots and everything. So we have this change in the world order that's happening. And my strategies use history to try to project out what the future could look like. And if the whole structure of the way things are being done changes, you want to be cautious about doing strategies like mine that rely a lot on historical precedent to carry through. It might not, and I would say probably won't be the same as it's been the past 75 years. So that gives me less confidence in buying something on the way down, buying a stock on the way down, because we could have an actual big reset of a business's model. Doesn't mean they're going to go bankrupt or anything like that. I mean, maybe Disney's a good example. I don't know. I'm thinking of them off the top of my head. There's a ton of them, but to find like a great here we go. Okay. So Disney has this big reset that's happening. It actually started, earnings started tailing off with cable, which is what this is kind of all about. This 2018 bump was probably tax cuts, right? So really without that, they had pretty flat earnings if you include buybacks and all that kind of stuff. And then they have this big reset here. Now the market was totally bonkers when it didn't see it actually happening in real time. But imagine this is happening, and they did eventually have a big reset here. See how far down they were? Maybe 50, 60%, okay, off that high. But for a lot of stocks, unlike Disney, they will predict this type of decline ahead of time. Basically, it would be an extension of this sell-off here that we saw going into the pandemic. Like really, if it never jumped up, which it never should have, it would just kind of be down here at the bottom, and then as earnings started growing again. But basically, you can go back to 2015, over 10 years ago, and you've earned no money from Disney, from owning Disney stock for 10 years. And inflation's up 30% since then. So you've lost money over 10 years. And that's one of the things that can happen with a lot of stocks. I wish I had... Wish I could think of another good example. There's quite a few. Probably the alcohol industry is going to have some. Maybe something like Estee Lauder, which I've written a lot about. Let's see. Yeah, so let's take this price off for a second. Well, no, let's leave it on. So what we see here is the market starts anticipating this decline that's coming about a year in advance, right? Like this big decline, the market saw coming a year in advance or a year and a half in advance and sold off almost 50%, right? So anybody that bought this on the way down that didn't understand, now it was very overvalued, but it could be a stock that's not obviously overvalued. There's a lot of them right now. And trying to buy one of these on the way down before the reset's in place, which I still don't think it's quite in place, but you're at least seeing some signs here that we're getting close, maybe. So you want to buy it. I'm not saying to go buy it because it has like a 50 PE, and the market's trying to anticipate the bottom, which is what it does on these bumps. So you want to be careful. But if you wait for a well-established bottom, you're just going to be much safer than all the people that are down like 80% or whatever this is down. Even after the bump off the bottom, it's down 75%. So these are the type of things that you want to avoid, and momentum and having positive technicals can help avoid the big drawdown, even if it means you're not going to pick, let's say this $50 ends up being the bottom. Even if you don't get the bottom, it's better than losing 50 or 60 or 70%. So, and this has to do with the collapse of the world order too, because these guys have great competition, but they were very dependent on China, sales in China, right? So that affects them as well. And there's all sorts of layers and layers, which I'm going to get into some more of these. All right. So the latest thing we have is Trump. President Trump has a ton of market intervention. I mean, I haven't looked it up maybe in the past month, but the number of executive orders compared to number of laws, I think he's over 300, maybe approaching 400 executive orders and less than actual 20 laws passed. And only a handful of those were for any kind of thing substantive. Granted, one of those was the big, beautiful bill, which was a big bill. But the country's basically being run by executive order. And so you're dependent on the will of the leader in a situation like that. And the rules that were in place before don't really apply, right? So you can't depend. It's kind of the same situation, this great kind of change that's happening. The government rarely buys big stakes in Intel, companies like Intel, companies that are mining lithium or rare earths or whatever, these announcements that you see coming out every day. That's very unusual. I would say really we did have some of that during the financial crisis with auto companies, I think a little bit of it, and maybe some of the banks, but really this is a wartime. You have to go back to World War II to see this kind of thing happening in America, in the U.S. As a normal course of action. And so it makes it very unpredictable when, well, let's say you're a competitor of one of these companies that gets an injection of money from the U.S. government, and that completely changes the competitive landscape, right? So there's layers upon layers of effects that it can have. We're just looking at like the first order effects. There could be third order effects that we can't even like imagine really, because it's so unusual. So that's another reason to be cautious, which builds into the next reason, and that's insiders. And I mean, by insiders, I mean both business and political insiders right now can, they have way more information than the public, and they can way more brazenly take advantage of that. And so you're going to see potentially them move the market ahead of whatever news comes. Now, this is always kind of the case. Like the market could anticipate, it's forward looking, a year or whatever. And so there will be people, there'll be traders and insiders and so forth, and just good traders that with a normal business can look ahead and see the negative thing coming and sell it. And so just like a cyclical, the stock price goes down well before the earnings go down, right? Because they can see it coming. Now, so far, we've mostly seen that. I don't even know if this is actually completely accurate, but we definitely see it on the stocks that are exploding higher because of the investments that the government's allowing them, the insider basically access. The Oracle, right? Obvious example. Let's just look at that one. So yeah, so blah, blah, blah. Oracle does nothing for 20 years. It might have made more money in the past. Okay, let's just go there to here. 7% a year for however many years that is, over 10, 11 years. And then, which is like 100% return. And now 400% in 3 years, right? And most of that came just recently on one of these government things. So it made more money in 6 months. The stock did. The stock price rose more in 6 months than it did during the 11-year period leading up to kind of this era. If you're basing things on history, like I do, primarily, like that's your baseline, you cannot predict what that is going to go up 100% in 3 months. You might get lucky with something that you already own, but it works the same on the way down is the main point that I'm trying to get. And you have to give yourself a little bit of grace for not being able to predict the oracles or whatever, Lithium America and whatever some of the other ones. There'll probably be more and more. Generally, I think it's not a good thing to have your business be completely held in the hands of the whims of whoever's in control of the government. But, I wouldn't be opposed if I had some little company that went up 500% because the government decided to invest in it or something. But the main point is on the way down, it's unpredictable because the government can cause the pain along with the pleasure, right? I don't know. There's so many, like in the healthcare industry, we have like the entire drug industry has kind of been flipped upside down, or is in the process of being so. So if you look at the history of Johnson & Johnson or something like that, and you say, well, things are probably like, now I realize they spun off Kenvue, which is where the Tylenol thing is. But if you look at their history, you're like, oh, it's pretty predictable. It used to be just as predictable as the S&P 500, right? Earnings, nice. But then the government comes after you or one of your main products or whatever. You can't really predict that, right? So the insiders there is going to be people that know what the announcement of the day is by the administration ahead of time, and they are going to take advantage of it. And if you did a study, I think I saw there is an ETF called like Grift or something. Don't quote me on it. I just saw it for a second. I don't have it in me to try to capitalize on like insider corruption or whatever. So it's not something that I would own, but, there are people that are going to know this is coming, have an idea how the market's going to react ahead of time and send the stocks lower. And I think you want to be careful on buying those dips that seem irrational, when a week or two later, the announcement will come and you'll realize what was going on, right? And they could have real earnings impacts, not just, stock market movements. So to be patient and wait for whatever it is to kind of news to come out, and maybe that affects the, stock, and to see how it works out and to wait for it to form a bottom, like I kind of showed with Disney a while back. That just seems like a more prudent way to do it in the current situation. So insider, and we know you can look at Nancy Pelosi's history and how good of a trader that she apparently is. That if you're in the insider of the government, this isn't like a new thing, but it's legislation would move a lot slower in the old days because we don't really have a legislation now. We just have like executive orders. So you could kind of see it coming. The lobbyists are paying money to get the legislation that they would like to see, or to prevent the legislation that they would regulate their business or something. So used to be a big, long, slow process that you could kind of see coming a little bit as the process was going on. Whereas now it's just all of it's behind closed doors. All of it runs through a single person, and you don't know really what's going to come. But the people there do, right? At least to some degree. They at least know what's on the table. So the stock could definitely sell off for a good reason that you won't know until it's too late, is what I'm trying to say. Okay, and then the other fifth thing is AI disruption, right? So there are going to be businesses that are disrupted by AI, and the people that really understand AI, or understand the businesses, or who are working in that industry and trying to deal with it, they're going to definitely see it coming before the average investor, especially if you use the type of style of investing that I do. As I said before, I'm not digging super deep into any individual business usually, unless I'm trying to figure out why things are so strange with some metric that I care about. But the people that work in the industries, they can see the numbers coming in before they're announced, their earnings. They can see what's being discussed. They can see what's being disrupted, and it will affect the stocks. It's not going to be an industry in secret. People are going to see some of these things coming. Now, they might be wrong about them ultimately. They might be wrong about how much the disruption is for an individual business, how much that business is able to adapt. But it's better to wait for the bottom than it is to try to figure out on the way down how bad it could be. So you can still take advantage of it potentially, but trying to buy it on the way down is probably not the best way, because the lack of information of the individual investor on any given AI disruption. And then there's going to be all kinds of hype and around AI because it's hot. So they're going to be, everybody's out trying to manipulate everybody to buy certain things and to believe certain things. And that's how just the internet is. But it can work on the way down as well as on the way up. But to me, things just pile on one another really quick in this market on the downside. So if in a normal market, if a stock might fall 50%, we're in a market where maybe it falls 75% and then it rises, and you can say, okay, that looks like a pretty good bottom. Things weren't as bad. You could still end up buying when it's 50% off its high, but you're buying on the way back up after the danger's kind of been identified and assessed. And again, you're not going to pick the bottom, but you probably weren't going to pick the bottom on the way down either. So that's worth considering as well. So AI, and that this is ongoing and difficult to figure out ahead of time. And again, there's going to be second, third order effects that disrupt a lot of industries and potentially the economy as a whole. So, all this can be said about the economy too, and not just individual stocks. The economy could be doing worse than we realize. There's always the delay. But the people, again, that are working in the industries, I've been looking at a lot of individual industries that are giving contrary views about how good things are or how not bad they are. Now, of course, they're getting more real-time data because they're in the industry. So it's not going to be data that's coming 3 months or 6 months later. That is interpreted and carefully selected maybe now by the BLS in some cases. So that information, again, it's out there that people are going to have it before the individual investor has it. And you're at a disadvantage. So you shouldn't think you're smarter than the market, I think, is what I'm trying to get at. On the way down over the short term. The medium term might be different. And we have to be really careful, I think, when trying to buy stocks on the way down. So, and then the last issue is, well, we did see that with Estee Lauder. So this is not an industry specific stock that I'm picking. I'm just saying, and Disney was the same way. This was a stock trading at a 50 PE. The valuations are high in this market. So when they start coming down on some of these stocks, they might look to people like they're cheaper than they normally were. Let's go back and let's go back to here, which is what it would have looked like at the end of 2023. And then let's we'll do like 10 years, right? And let's put normal PE. Oh, it's not. Hold on. We got to back up one more year. Normal PE for this is 30 with 12% growth, which is crazy ridiculous. It's probably even more if I brought it to the peak. So normal PE, still about 30. Really expensive, right? And if you expect that this will that it's normal for this to trade at a 30 PE, let's go. It was a 30 PE right here on that dip, and you bought right there, which it looked pretty smart at the time. You're down 60%. So because we're going from elevated valuations on a lot of these stocks, again, this kind of goes back to the stimulus boom bust too. They can sell off a lot more than people realize. And if earnings fall a little bit, they fell a lot in Estee Lauder's case. So it's a certain example, like a exaggerated example. But if earnings fall just a little bit, that shift can send these stocks down a lot. And you shouldn't expect, just because there's a lot of these steady earning stocks like Brown-Forman, right? So steady earning, but valuation at 50 again. Now it's at a 15 PE, which is where it should have traded all along. Okay. So if you use something here like a normal PE, which is 26, right? Then you're going to be in trouble. You're going to be paying too much because it should have never traded there. And there's big resets going on, and there's a lot of stocks like this. So again, if you're trying to buy this on the way down, even if the PE gets to where it was historically, it never should have traded at such a high PE during most of this time to begin with. Now it's probably closer to like fair value if they can bottom these. But again, this isn't something I want to try to buy on the way down. This is something I want to establish a new base. And if the stock, you have to pay more for it, so be it. It will usually save money. There might be some that get missed out on. It kind of depends on the business and how generally good the business is anyway, how much you want to risk it. But good reason to have momentum, like they're in technical bottom. Like that never happened during this entire way down with these guys. And it would have saved investors a lot of money. I think that's it, right? So the basic theme here is you have to understand where you are informationally as an individual investor, and that is at the bottom of the freaking totem pole right now. For all the reasons that I've talked about, and because what you're saying a lot of times when you're buying a stock and as a value or a valuation based investor is the market has it wrong here, at least over the medium term, and so I'm going to go in and buy it because the market's too short-sighted or something like that. So that's kind of what you're almost always saying when you're buying a value stock. Or just a valuation-based stock. It could have growth. I'm not talking about price to book. I'm talking about growth at a reasonable price, basically, stocks. The market is going to know a lot more than you before you know it. And you really have to respect that in this type of environment. I think we're getting into a situation where it's always like this, but like I said earlier, you want to think first about the downside. And what if you're wrong? And what if the market's right is maybe the better way, especially over the short term. The people who are willing to act on it are going to know what a lot of these policies, strategies, and adjustments that governments are going to be making are ahead of tariffs. I didn't even talk about tariffs, right? I mean, it gets piled into the other executive orders and stuff. But all those things other people are going to know about before we even get a whiff of it. And some of that, or a lot of it's going to be reflected in the stock market before we understand why. So what I'm saying is respect that. Don't try to be smarter than the market over the short term right now. This is a very difficult time. Now, if you work in a specific industry and you know stuff and you can see it, that's totally different. That is probably really useful during times of rapid change. But don't go to Reddit and listen to what somebody on there, or YouTube or whatever. I say that as opposed to YouTube. Or I would just say be careful about listening to stuff on the internet. If you have firsthand knowledge, that's totally different. That's a great advantage if you can see what's coming. But if you don't have that, then be careful and just wait and let the stuff shake out and see where we're at, and then come back and consider buying the ones on the way up, right? Okay, so this is meant to be an explanation video. When I get into all these individual valuation videos coming up and I'm like, wait for positive momentum, I've already been doing it, but this is like my explanation why. And this is where I'm going to refer people back to when they're like, Corey, the valuation looks good. The valuation looks good. And it's like, yes, the valuation looks good right now, but we don't know what the market sees is coming. The market and political insiders see is coming. And there's no way we can know. And so we want to just be careful and see how some of this shakes out. We're willing to pay a higher price potentially for the good ones by not taking on that lower risk, that risk of buying too soon, basically. All right. Thanks for watching, everybody. I have a free tier over on Patreon. Go check that out. I'll see everybody later.